Welcome to Season 2 of the Cryptopulse podcast, your ultimate guide to the world of crypto, Bitcoin, and world economics. We're here to guide you through the crypto universe with thought-provoking topics, in-depth knowledge, and information to help you make informed decisions. We'll also be interviewing some of the best minds in the industry, such as CEOs of crypto projects, traders, economists, authors, and development teams from around the globe. And now for the episode.
Marius, welcome to Cryptopulse. It's great to have you here. We were chatting off air just a minute ago, and you said this is your first podcast. So congratulations on your first podcast appearance. And we're honored to get you on our show to talk about Hubble and Kamino and what you guys are building. So before we go into the project itself, could you tell us a little bit about yourself, your background, and how you got into the world of crypto?
Yeah, thanks a lot for having me. Yeah, so as a profession, I'm a software engineer. I used to work in a financial company working with building systems for pricing exotic derivatives. Our company was offering prices for a pricing service for things like swaps, all sorts of derivatives, swaptions, and so on. And I was working on the back end, writing C++ and OCaml, having to understand the models, having to understand the technology, and spent about 8 years doing things around that. About a year and a half ago, a friend of mine told me about Pancake Swap, and I was farming some coins there, and I was just first time using a wallet, and it was all very scary and but exciting. Right? Yeah, I mean, I was doing things like LPs, and it just made no sense. And I did think I knew something about finance since I was working with derivatives, but it was extremely confusing. So I just started being curious. And I went on like the Binance Academy or something, and I was looking, what is LP? What is the liquidity provision? What's this yield that people talk about? And for a very long time, I felt completely stupid, and I just don't understand anything. But as it was a bull market and people were making money, and I was making some money, it just kept the interest alive. I started thinking, I started seeing all sorts of protocols coming up everywhere. And I saw news about a Solana hackathon, this new blockchain at that time that was really exciting. And someone posted on Twitter that if you know Rust and you want to participate, it could be a good idea. And I loved Rust. That was one of my passions. I was writing Rust code outside of work. I had a blog. And I just wanted to see how it is to write Rust for blockchains. And basically, I spent about a month after work and in the weekends trying to build something, and I thought that's really cool. I absolutely loved it. I read some white papers, and it really dispelled the myth that crypto is this massive scam. There were white papers about incentives and game theory and finance and optimizing for specific things, and I thought that this is really cool. At the end of the hackathon, basically, I thought that it would be very cool to start to try to build something. I talked to a friend of mine at that time, and I said, is it possible to raise funds to build something? And because it was bull market, everyone was more than welcome to hear your ideas. And that's basically how it started, the story before Hubble.
Okay, gotcha. And as a software engineer, what were your thoughts on things like Pancake Swap and the difficulty of using that platform?
So all I knew about Pancake Swap was that it was written in Solidity, and it was built on top of the EVM, but held the nodes were being run by Binance validators, right? The front end. It didn't look amazing at first. Now it's much better, but you can't really judge. It was just all this big mental barrier for me. I couldn't understand what was happening. But from a technical point of view, I was not attracted to Binance or to Ethereum because for me the language that you used to code was Solidity, and I felt that Rust was a much better language. And that's what, this curiosity led me to Solana rather than, picking this Solidity-based chains.
I want to get into some more details about like what you've built. So maybe you could tell us a little bit about Hubble, Kamino, what it is, and like the problems you're trying to solve. Because I think any good crypto project is always trying to solve a problem in this space.
So when Solana was getting started, there was this rush to try to bring all the primitives that you need for a DeFi ecosystem to function. So if you can't have just one DEX on a DeFi ecosystem, because all that you can do is just swap between one token to another. But if you start bringing a borrow platform, for example, or if you bring a margin trading protocol, then people can start leverage trading. For example, they can leverage up on a specific token, or they can short a specific token. They can express more views. Then if you have, the more things, the more kinds of protocols exist in an ecosystem, the more views can be expressed. And then as complexity happens, more and more needs appear. So Solana was at the beginning of the road. It barely had a stable coin. It didn't have any borrow lend platform. It didn't have anything. So I think at first the need was to just solve this lack of primitives. So that's why we set out to build Hubble. And Hubble basically offers a stable coin backed by crypto assets. So for example, in the most common one is Maker in Ethereum, where essentially you can deposit collateral in the form of Bitcoin or ETH or other things, and you can mint a stable coin. And that stable coin is pegged to $1 through various mechanisms. And that was the need we set out to solve. And because you have a stable coin backed by crypto assets, essentially what this allows you to do is gain leverage. You can deposit Bitcoin, mint the stable coin, and then you can use a stable coin to buy more Bitcoin, for example. And then you can mint more stable, and you can loop that. So it allows you to have depth in a stable coin, but have a much bigger exposure to Bitcoin or to ETH. So one of the needs it solves is the need for leverage. The second thing that it solves is that because you need stable coins in crypto for many things. One of the things you need is for tokens to trade against each other. Everyone trades against dollars. It's much easier for us to reason about the price of something versus a dollar rather than ETH versus Bitcoin. So most of the tokens are traded against stablecoin. And the current stablecoins that existed at the time were just fiat-backed stablecoins. And fiat-backed stablecoins essentially are, they're fine if things are calm, but they pose some existential risk for the ecosystem, in the sense that, if I'm a person from some other place in the world and I use a stablecoin backed by dollars in a US bank account, then I am directly exposed to US regulations.
Right.
And I'm in a completely jurisdiction. Why should I be exposed to US regulations? So having a stablecoin that is not subject to US regulations is another need that we set out to solve. We've seen what happened. This prophecy is starting to unfold, but we don't know for sure if it will fully manifest. We've seen what happened maybe 2 weeks ago when USDC froze Circle froze some USDC accounts. It was, you thought it's your money, you thought it's your money on your wallet, and the narrative is that is your wallet, your keys, you have full control. But in fact, you have USDC that is controlled by US entity, and they have freeze authority over your funds, and then that's it. So I think the total amount of wallets that were blacklisted, or the total amount of assets blacklisted, was something like hundreds of or tens of millions.
Yeah.
In ETH and Bitcoin, so those wallets were blacklisted, but in USDC much less. So it solves the need for censorship resistance for a stable coin. And once you have the stable coin, the stable coin is needed for trading, like I said. Secondly, for leverage. But in many cases, if you want to trade on margin, so let's say you want to buy an option that gives you some leverage, or you want to buy a future or a perpetual future, you always trade with leverage. So when you trade with leverage, you need to collateralize your position in case you get margin called, So that collateral is also usually in a stable coin. So different protocols, different derivative protocols might need a censorship resistant stable coin as collateral, because if their collateral gets frozen, then the entire positions are bad debt under collateralized.
Yeah, it's a really interesting point. Actually, I hadn't thought about some of the risks of stable coins in that respect. Marius, I want to kind of jump back to a couple of weeks ago. I know you guys launched Kamino Finance. I think it was about 2 weeks ago now. It seems as though the launch was really successful. I'd like to kind of just get your sort of take on how the launch went, and if you could just kind of talk us through some of the plans for the coming months.
Yeah, so maybe a bit of context as to what Kamino does. Kamino basically takes two tokens and provides liquidity on a DEX for those two tokens. So for example, 2 years ago, there was only one way to provide liquidity on a DEX. You put both amounts, and then an equation, a function decides at what price, how much do you swap in and how much do you swap out based on a fixed formula. And that worked well to begin with, but a lot of shortcomings have been identified with this model. And the main one is capital inefficiency. So, for example, you have USDC, let's say USDC, USDH. And if you have $3 million locked in a pool, with the old model, you can only swap something like 500K or 600K without slippage. The rest of the money, the rest of 3 million do not participate in the swap exactly. After 600K, 700K, you start having a lot of slippage.
Yeah.
And the next iteration of this model was created by Uniswap. So it's called Uniswap V3 model, and it's called concentrated liquidity model, where essentially you can choose to deposit liquidity in a much tighter range, such that for lower TVL, for much less liquidity deposited, you can have a bigger swap with no slippage. So essentially, it's like concentrating the liquidity. And the problem, it's great that what they've managed to solve, but it adds complexity for the user. So the user now has to think, okay, in what price range do I deposit liquidity for these two tokens? How about these two tokens? In what price range and in what price range? And let's say you deposit in the price range of 0.099 and 1.01 for a stable coin, and then the stable coin goes up or depegs, then your liquidity is no longer participating in swaps, which is the whole point of providing liquidity, is to market make and to make money from swaps. But because you're out of range, you're no longer making money from swaps. So it asks you to have to come and withdraw that liquidity, deposit in a new range, and keep rebalancing manually every time. And Kamino is essentially automating all of that process. Kamino is identifying for this trading pair, what is the current price? Has the price changed? If the price has changed, it puts liquidity where the new price is, and it just keeps rebalancing the positions such that your liquidity is always making money from swaps. So it's giving the UX of the old model of just depositing two tokens and forgetting about it, but on the new model, which is more complex, and just handling the complexity under the hood, such that for the user it's very simple UX. We identified this need because we wanted liquidity for USDH. That was the reason why we built this, right? The liquidity for USDH in the old models was we thin. So for some big swaps, you would get slippage, and the stablecoin could potentially depeg. So we thought we wanted to be on a concentrated pool, but then it was hard to manage. Yeah. And also, we didn't want to deploy our own liquidity. If people want to deploy liquidity, it's hard for them. So it was blocking people from depositing into these concentrated pools. Only people that were super motivated were doing it and tracking daily and so on. But it removed this like passive kind of set and forget strategy. So we decided we want to do it for USDH, and we built it with that in mind. The other need that we identified was, if we take this position as collateral in Hubble and we allow people to leverage it up, so let's say you make 5% fees from swaps, and you pay 1% interest rates to borrow to do more of that, and essentially have like something like a 4% arbitrage. So if we allow people to loop it a few times, then they get much bigger exposure and collect more fees. And at the same time, it allows USDH to have deeper and deeper liquidity, because that position is being looped many times and deposited as collateral in Hubble, and it creates deeper and deeper liquidity. So that was really why we set out to do this. We wanted to make it easy and also to deepen the liquidity of USDH. That was the goal number one. And then, we start thinking, okay, where can this go? We were not the only ones facing this issue. Other stablecoins face the same issue. So if it's usable for Hubble, then it's usable for all the other stablecoin protocols in Solana. There's another asset type that is also facing the same issue, which is pegged assets. So you're probably aware of ETH and staked ETH, right?
Yeah.
In Solana, I have Sol, staked Sol, Sol, MSol. All of these assets, they have the same behavior. They're pegged to each other, and they only slightly deviate as the stake derivative keeps earning some yield. So they have the same issue. So we can do it for stable coins, and we can also do it for pegged assets. And we just want to help basically any DAO or any entity behind the stable coin or behind the pegged asset, for example, a stake derivative, to get better liquidity for their token, much more efficient swaps, so that people can swap easily, people can deposit easily, people can collect fees. And so it's literally for everyone, for every DAO that has a stablecoin wants liquidity for it, every Sol derivative that wants that. The goal, moving forward, is to keep increasing this offering. So launching pools with more kinds of derivatives. In Solana, there are quite a few stake derivatives compared to it. Then using these tokens that we issue as a kind of like a receipt token as collateral in Hubble or in potentially other lending protocols, allow people to leverage up that position. So they leverage up the trading fees. And the second thing that we're working on is, when we decide to deploy the position, how do you choose the range? Is it like 99 and 101, or what range do you choose? And that range, is not super obvious all the time. So we have developed some models that we've backtested that spit out, suggested ranges. So we want to keep refining those models to have better and better range suggestions, such that we balance as efficient as possible. So we capture more and more fees rather than having a wide range at the moment, which is still conservative, to make sure everything is stable and works fine. So we want to keep improving the models and improving the offering with more stable assets and more pegged assets.
I think the next question that we had for you was really just around security at Hubble, and just how do you make sure that you have optimal security for your users, especially during periods of market downturn?
Yeah, so there are basically two kinds of security that you have to worry about. One is the classic one where just someone steals something from you.
Right.
Like just general hacks, right? Like some input is not validated correctly and an attacker poses as a valid user or poses as the admin or something, and then it can just steal as if it's his own money. So that's one sort of security issues that you have to deal in a different way, managing the risk of basically of the assets and liabilities. Because Hubble offers loans, just like Aave, just like Compound, you need to make sure that the lenders, they always receive back at least what they put in. So the lenders don't have basically bad debt. They don't incur a haircut. For example, it could happen in a scenario when you lend USDC to someone, that person borrows Bitcoin, and Bitcoin drops so fast that by the time you liquidate that person, he has much less worth in collateral Bitcoin than he borrowed USDC from you.
Right.
So basically, people model this in different ways. The idea is, how fast is the blockchain? How quickly can I liquidate someone? And that's much better in Solana than in Ethereum, for example. So you can send many more transactions much faster in Solana. The second one is the assets that you offer as collateral. How volatile are they? If I collateralize my loan, if I put my loan as collateral for something, my Bitcoin or like my other coin as collateral for something, how fast can that drop in price? And is that drop too fast for me to catch it and liquidate it in good time? And secondly, how big is the collateral? If you're gonna put something like one Bitcoin, you'll be able to take a Bitcoin and sell it on any DEX with no slippage. But if you're going to take 5,000 Bitcoins or just hundreds of millions of dollars, and if you try to liquidate that immediately on a DEX, then you're going to incur something like 50% slippage.
Yeah, of course.
So the question becomes how volatile is the asset, how fast is the blockchain, and how much liquidity there is for you to do liquidations. So, you can do like some super advanced quant analysis, but you can just do like very like rules of thumb, right? So let's say the total collateral in the protocol, if I am to sell it now all on the DEX, what is the slippage? If the slippage is more than my liquidation penalty, then I either need to decrease the collateral cap or increase the liquidation penalty, such that liquidators are motivated to come and clear the debt when the time comes. So that's how you think about it, and basically different coins have different characteristics, and that's how you set the deposit caps. And yeah,
I mean, this is such an in-depth project and something that's required a lot of practical thinking and sort of esoteric thinking. Who's in your team that has helped you come up with the sort of the architecture and the concept for Hubble, and how have you found the recruitment process and finding the right people to deliver on this?
So when Hubble started, it was something like, it was an obvious product market fit, a stable coin, right? We know that stable coins work, and every thriving DeFi ecosystem needs a stable coin. So we set out to do that. And as we started talking to people, they all started asking questions about, okay, what collateral are you going to take? How do you protect in case of a hack? How do you protect in case of a market downturn? And then all of these questions, initially we didn't have them, so we had to prepare them for the next discussion, So it made us think. So we just talked to a lot of people that have been in crypto or traditional finance for a long time, and these ideas started taking shape in our minds. The second thing we did was, after we went live, there were so many hacks. Every single day there were hacks after hacks.
Right.
So we were like, we have this like attitude of the hack is the last thing that can happen to us. It's just the worst thing that can happen.
Right.
So we started thinking, how can we lose users' trust? What can happen in case of, if we design something bad or if we code something badly, what can happen? So, and then all of these things that were moving, we started thinking about, what happens if Bitcoin drops a lot? What happens if ETH drops a lot? What will happen with the peg? And then we started adding like monitoring and alerts and all sorts of metrics so we can watch what is happening. Basically, little by little, we started like covering the gaps. I think it's just like, generally, to get back to your original question, we didn't hire any like risk manager, or we didn't hire anyone to do security. Literally, basically every single person in the team has been kind of nudged to think about security as much as possible. And with, if someone comes up with a suggestion to improve security, it's always very welcome. So we have this attitude. It's kind of, I think, healthy or more aggressive attitude towards security, such that everyone is like kind of enjoying it. Yeah, that's basically it. And like my background I was doing derivatives pricing before. We always had to calculate analytics for derivatives. So what would happen to the price of this derivative or the price of this portfolio if the market goes down by 1%, or if the market goes down by 5%? So you have these like term key rate risks, or like delta risks, or like all of these metrics. So naturally we started thinking about this and trying to incorporate them. But ultimately, at the end of the day, we always thought about how can we keep the peg? How can we keep it healthy? How can we service healthy loans? And by just trying to think it from first principles, we removed a lot of like initial design features that thought would be very cool, but we realized that they just don't stick. And literally the thing we kind of settled on are just, age-old principles of finance, like just interest rates, cost of capital, having a reserve, raising the rates when there's too much supply, increasing the rates when there's increasing the rates when there's too much supply. So all of these things, we had to kind of discover them. And we realized like, wow, we're like macroeconomists, but we're not. We just like had to learn them. We added something recently that I'm really, really proud of. We added a thing called net outflow caps. It's a feature that we learned from traditional finance. But basically, every single time something exits the protocol, it records it on a variable. And that variable is like kind of like it just keeps growing as time goes. It just keeps growing, and then we reset it every 4 hours, and then we put a cap on it at the 4 hour mark. So if there are more outflows than we set the cap, then every action is rejected. So if like the net outflows per day are like within the interval, nothing happens. Everything is fine. But if there's an outsized withdrawal, the caps are triggered, nothing happens, alerts are ringing, and people, if there was a valid withdrawal, are invited to go to Discord and put a proposal, and then the multi-sig behind the program will vote to change the cap, for example, if it's urgent. Otherwise, if it's malicious, then we basically at least limited the downside, so they only got max what they wanted to, what the mark cap was set.
Nice. Yeah, I think that's an interesting solution to a problem I've heard quite a bit. Have you noticed, because I know that you guys are relatively early in your journey, I mean, have you noticed any sort of differences to the way that the product is operating now during the bear market versus, how you expect it to operate during, maybe the bull market 24, 25?
Yeah, of course, it's huge difference.
Yeah.
We did launch in January, and February was still relatively bull compared to what is happening now.
Yeah.
And then there was a brief comeback around May, I think, or something like that, or before May, before the USD collapse. And you literally can see as the market goes up, so like Bitcoin, ETH, like the main ones go up, then the amount of leverage goes up. So people are willing to buy more to get exposure to the token, right? Because they have ETH, they take a loan, they buy more ETH, so then they have 2 ETH exposure, right? So they are long ETH. And as market goes up, they leverage up. When market goes down, they repay, they close their positions. So it's super correlated. So leverage is highly correlated with the direction of the market at the
Interesting.
moment.
And just from your perspective, because obviously you've got eyes on the data, is there anything in particular that you might be able to see on your side that would give you an indication that the market sentiment might be turning? Any sort of unique indicators that might give you a clue?
I'm not sure.
People starting to confidently leverage up. Yeah,
I think you need to get some Aave or some compound guys to give you more data, because they capture such a bigger share of the market, right?
Sure.
Yeah, we're planning to speak to Aave soon. Actually, we've been wanting to speak to those guys for a while. So for the rest of this year and going into next year, like what's on your roadmap? What are you looking forward to, and what can some of our listeners look out for? So
the way we look at like DeFi, for example, if is the best one, right? There were primitives built. Primitives attracted capital, and that capital wanted to do new things, and then new products were built around to serve those needs. And then more complexity happened, and then more needs appeared, and then more products appear. So that's why I have such a rich ecosystem that keeps attracting capital, And then if you go to ETH, you can have all sorts of directional views, or like express your views about like, okay, it's going up, or it's going down, or it's going this much, or you can express views in many ways. So that's what you need for an ecosystem to thrive. You need primitives, and then primitives attract initial capital, and then you need things that serve those people, automate things, for example. Then you need to allow them to speculate on various other parts of the ecosystem. So we want Solana to grow. That's like a clear goal for Hubble. We want Solana to grow. Mm-hmm. And because of that, we want Hubble itself to be a solid primitive that people can use. Then secondly, in the beginning half of this year, Solana had these new AMM dexes appeared. So of the CLMM type, right? ETH has had them since last year, but Solana just got them this year. And now Hubble incubated a new project called Kamino that is building on top of a CLMM. And it's basically tokenizing liquidity on a constant liquidity market maker to make it easy for people to deposit liquidity there. So to explain basically why this is important, in 2020 you deposit liquidity to tokens, and then if the place where you deposit liquidity has a lot of usage, it means your liquidity will serve many swaps, and each swap incurs a fee. So that means you keep accumulating fees. So that's the goal of a market maker. The goal of a market maker is really to accumulate fees. But then we realize that sort of model is broken, and it's like extremely inefficient. To serve a 500,000 swap, you need way more capital. And then people created the Uniswap v3, which is much more capital efficient. So you can say, I want to serve swaps between this price and this price. And then you can serve many more swaps with less capital. It's like kind of a halfway between a normal AMM and an order book. Order book being the most flexible of all, but also the most complex of all. And then when people came up with CLMMs, it became extremely complex. So how do I choose the price range? Before that, I just put to deposit to tokens and I forget about it.
Yeah.
Now with Univis V3, I need to think of the range. But how can I even think of the range? Because I don't have a quant, I'm not a quant. I don't have models. I don't model volatility. I don't have predictions. I don't have, machine learning. So how can I model the price range in which I will maximize my swap fees? So people started building on top of that in Ethereum, and then we also did something similar in Solana. It's called Arrakis, and it basically makes market making for stable coins and for pegged assets user friendly. You just deposit one token. You don't have to deposit two. You just deposit one token. We handle the auto swap, the rebalancing, everything. This creates new needs for people. Basically, they want to integrate with this. They want to take it as collateral so they can leverage it up. You want to express different views with these like CLMM markets. So maybe, for pegged assets, it's pretty simple. But for volatile assets, you might want to do the same thing, but that becomes even more complicated. So we're thinking about that as well.
That's given me a lot to think about in terms of like providing liquidity as these markets expand. I want to ask you a question that we ask most of our guests, because I think this gives us an insight as to you as a person. But is there anybody in the crypto and blockchain space that you particularly admire and that you think has done an incredible job in terms of helping this whole ecosystem grow?
I mean, without picking someone controversial, it's pretty obvious that Anatoly from Solana has done huge amount of benefit to everyone. So he built this ecosystem, right? This DeFi system that is cheap. Built it in like much better, let's say, with better software engineering principles, so that people can build on it with more confidence. And he does it like, it's really humble, and it's like very similar to Vitalik, and very opposed from other blockchain founders. So it's very inspiring to build on Solana. So I think it's good to follow. And he has this attitude where like he has constant FUD being thrown at him, right?
Yeah, right.
Because like Solana was going down for a while, but even because of that, like people would have picked on it no matter what, because tribalism in crypto is just super high, right? So you have to handle your network going down and then the FUD, and then you need to keep a clear head to keep building for the future, right? And now things that are coming to Solana I think they're groundbreaking. So I really admire that he has kept this like healthy builder attitude.
It's so interesting actually, because every project that we spoke to that's building on Solana has just spoke so highly, and the crypto community can be really tribal, especially on Twitter, and you see a lot of people maybe saying things about Solana that aren't as good, but the fact remains, what they're actually managing to do to attract builders and to work with people like yourselves. I don't think there's many other blockchains that are doing it at that scale. So I think that's super bullish for the Solana ecosystem.
I 100% agree. Yeah, I mean, I also met him in person. He just like, so Solana has these things called hacker houses. They happen, I think, once a month in a new city.
Yeah.
And highly recommend people. It's like, really like devs only almost. And Anatoly goes to some, and he just walks, and you can just ping him, and you can just ask him, and you can ask him the hard questions, or like ask him what he thinks of your protocol. So he's really willing to learn and listen, and I think he's very neutral. I think it's really cool, like that we have him.
Definitely. I need to get some more Solana in my portfolio, I think. Never feel like I've got enough. Is there anything else that you wanted to say or cover off on today's episode? I think we've covered quite a range of different topics and discussion points. Is there anything else that you wanted to tell our listeners at all?
I mean, we're at this time in September 2022, and it's like everything is down, and it's hard to see how it will go. But I think the point is that crypto is still like a derivative of the macro environment, right? So if the macro environment is bad, crypto itself will be bad, right? Like even just normal stocks are down. And also there's regulation and all of that. That is uncertainty that you don't know how to handle. But there's a lot of people building really interesting things. And I think that's really positive. And, just like the internet took a while to actually find product market fit, or like AI itself, machine learning took a while to find product market fit. I think now you see just amazing products coming out of it. So I think blockchain and DeFi will have its own, but we have to go through these times, and there's a lot of like discovery that has to happen. We're building the most obvious ones, but let's see what new needs we identify or new applications we identify later. And Hubble wants to build and try things, and I invite many more builders to just check it out, to try it out. It's definitely wide open for people willing to build, to put their time and the effort.
I agree. We're so early in this space, and I think like the average retail investor or even builders in this space sometimes can be sort of swayed by such negative market sentiment. But Ben and I were talking on our last episode actually about this topic, because I just know what it's like at the other end. So when people are insanely bullish and saying, hey, we're really early, and Bitcoin's going to go much higher, just hold and hodl. And the same applies for the negative side of it. And I kind of feel like we're reaching a market sentiment bottom. I mean, we've been through a couple of cycles now, but the fundamentals don't change, and builders are still creating some amazing things. And we get to speak to some incredible entrepreneurs in this space. And you've just got to have a long-term view on it. Otherwise, you kind of wouldn't get anything done if you looked at what's going on this year.
Well, the good news is that a lot of people think like you, and investors. There are many investors willing to help a project grow if there's value in it. So builders are not like they don't have to like build in their garage. It's like there is enough capital that can sustain them if they want to try out.
Well, look, good luck with everything. I mean, it's great what you're doing, and fantastic for the Solana ecosystem. So we'd love to catch up with you again in the future. So if anybody listening, if they want to find out a bit more, where's the best place to go? Would it be your website initially?
Yeah, we have basically two. So hubbleprotocol.io and Kamino.finance with a K, Kamino.finance.
Sure, and we'll put those links in the show notes so people can view that as well. But Marius, thanks for coming on the show, and we do appreciate your time greatly. And good luck to you and the team.
Thank you. Thanks a lot for having me. It was really good.
Thanks.
See you both.
We hope you enjoyed this episode. It would mean the world to us if you could leave a review wherever you're listening. This really does help and allows other people to find us online. You can keep up to date with new releases of the podcast by subscribing and following us on Twitter or Instagram for the latest crypto-related news. Information provided by Cryptopulse via this podcast, website, social media channels, and any other medium does not constitute financial advice, investment recommendations, or any other type of advice whatsoever. The Cryptopulse team are not professional financial advisors. Trading and purchasing cryptocurrencies do carry risks, and anybody wishing to partake in such activities should seek professional advice.